Water is basically the absolute lifeblood of civilization. But let's be honest, you and I really only tend to think about it when something breaks.
Right? Like when the tap just runs completely dry.
Exactly. Or, when your basement suddenly floods, or when that monthly utility bill just randomly spikes out of nowhere.
Yeah, that's usually when people start paying attention.
Right. But behind the drywall in your house and buried deep under the asphalt of your street, there is this massive, incredibly complex global economy that is built entirely around managing every single drop.
It really is a huge hidden industry.
It is. And today we are taking a deep dive into the financial engine of that exact economy. We are looking at the Q1 2026 results and earnings presentation from Xylem Inc., which just dropped on April 28, 2026.
And just so you know where we're getting all this, we were pulling directly from Xylem's official Q1 earnings press release, their presentation slide deck, and, well, the pretty dense financial appendices they provide to their investors.
Yeah, lots of spreadsheets. But our mission today is to decode what a multi-billion-dollar water technology company's ledger can actually tell us. Because it turns out, looking at how they make and spend their money gives us a really fascinating window into the current state of global infrastructure.
Absolutely. It shows us the shifting demands of modern technology, too.
And, how to navigate a really tricky macroeconomic environment. Because by the end of this deep dive, you'll see exactly how a company manages to fight off heavy inflation while at the same time trying to fuel the future of critical infrastructure.
That really is the core of it. I mean, when you open up one of these earnings reports, it is so easy to just get totally lost in a wall of numbers.
Oh, yeah, it can be overwhelming.
Right. But if we break those numbers down, they act as a map, basically showing us exactly where the world is currently prioritizing its resources.
Okay, so let's unpack this. Before we dive into the really heavy financial lifting, we need to establish the sheer scale of Xylem, just to give you some context.
Yeah, they're massive.
Right, this is a Fortune 500 company. They have 22,000 employees operating all over the world. And in 2025, they delivered $9 billion in revenue.
$9 billion. That's a lot of pumps and valves.
Seriously. And they are organized into four main business segments. You have water infrastructure, which handles the massive, heavy-duty civic pumps and wastewater systems.
The big municipal stuff.
Right. Then you have applied water, which deals with commercial and industrial water usage. There's measurement and control solutions, often called MCS, which we can think of as the digital brains and smart meters.
The tech side of the business.
Exactly. And finally, water solutions and services, which is essentially outsourced operational expertise. And through all of this, the U.S. remains their absolute strongest geographical market.
Yeah, the U.S. is driving a lot of it.
So basically think of Xylem not just as a company that manufactures pipes, but really as a planetary circulatory system manager.
I love that. Planetary circulatory system manager is a highly accurate way to visualize their role. And looking at their forward-looking statements in this report is what makes their performance such a crucial bellwether for you to understand.
How so?
Well, in their disclosures, they explicitly list the massive macro risks they are up against right now. They cite inflation, ongoing logistics, and supply chain challenges.
Which everyone is feeling right now.
Exactly. Plus, extreme volatile weather events, cybersecurity threats to connected infrastructure, and severe labor shortages.
I mean, that reads like a checklist of every major anxiety-inducing headline from the past year.
It does. And that is precisely why this matters. Municipalities, federal governments, and private industries are all trying to weather those exact same storms. So Xylem's financial health serves as the perfect diagnostic tool.
Right, like taking the temperature of the global economy.
Exactly. Think about extreme weather changing climate patterns. A 100-year flood isn't a 100-year event anymore, right? And that severely stresses municipal water systems.
Oh, for sure.
So if Xylem is struggling to source parts to fix those systems due to logistics challenges, that tells us the global baseline of infrastructure is under immense pressure.
And on the flip side,
conversely, if they're navigating these headwinds well, it gives us a blueprint for how essential real-world industries can actually survive in a volatile decade.
Okay, so let's see how well that circulatory system is actually holding up under all that pressure, because that brings us right to the Q1 scorecard. And there is a serious margin tug of war happening here.
There really is. The numbers are fascinating.
Let me just run through the headline financial facts. For the first quarter of 2026, Xylem brought in $2.125 billion in revenue.
Huge numbers.
Right. And at the same time, they secured $2.228 billion in future orders. Now, both of those numbers are up 3% on a reported basis compared to Q1 2025.
But there's a catch.
Yes, here's a catch. Crucially, they're totally flat, 0% growth on an organic basis.
Right. And for anyone who doesn't spend their weekends analyzing financial appendices, we should probably clarify what organic actually means here.
Please do.
So organic growth is a metric that strips out the impact of currency exchange rate fluctuations. And it removes any revenue that came from companies they recently acquired or sold off.
So it's like a baseline.
Exactly. It is the raw apples-to-apples measurement of how much their core existing business actually grew.
Okay, so the core business demand was basically flat, 0% organic growth. But here's where it gets really interesting. Despite that flat core growth, their adjusted earnings per share, their EPS, jumped 9% to $1.12.
Which is a very solid jump.
And furthermore, their adjusted EBITDA margin expanded by 20 basis points to 20.6%. So I have to pause here and ask for a quick translation. EBITDA margin expanded by 20 basis points. Break that down for me using real-world terms.
Okay, let's use a household budget analogy. EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Quite the mouthful.
It is. But imagine you run a neighborhood bakery. Your EBITDA would be the cash your bakery generates just from selling bread and pastries, before you pay the interest on your small business loan, before you pay your taxes, and before you account for your ovens getting older.
Okay, that makes sense. It measures your pure operational profitability.
Exactly.
And the basis points.
Right, so basis points is just finance terminology for fractions of a percent. 100 basis points equals 1 full percent. So when Xylem says their margin expanded by 20 basis points, it means their profit margin grew by 0.2%.
Got it. I mean, it sounds like a tiny fraction, but when you are dealing with over $2 billion in revenue, 0.2% is literally millions of dollars in extra profit.
Exactly. It scales up fast.
Which brings me to a major question. If their organic growth is technically flat at 0%, how on earth are they expanding their profit margins and driving their earnings per share up 9%? Like, is this just clever accounting, or are they genuinely doing more with less?
They are genuinely doing more with less. In the sources, management describes this exact dynamic as an operational tug-of-war.
Okay, who's pulling on each side?
Well, on one side, Xylem is fighting heavy headwinds. The materials detail how inflation is pushing their material costs up. They also faced an unfavorable product mix this quarter, which simply means they happen to sell more of their lower margin, less profitable items than their high margin items.
Bad luck on what flew off the shelves, basically.
Right. Plus, their overall volume was slightly down, so those forces are constantly pulling their profit margins downward.
So what is pulling in the opposite direction? How do they actually beat inflation and a bad sales mix?
Through sheer operational discipline. The slides specifically highlight productivity and price realization.
Okay, let's strip away the corporate jargon. What does productivity mean here?
Productivity just means they're aggressively finding ways to manufacture and operate cheaper. This could look like optimizing a factory floor layout, so a water pump takes 10 fewer minutes to assemble.
Oh, wow.
Or it could be renegotiating bulk rates for raw materials, or simply reducing administrative waste.
Okay, and the price realization part?
Price realization means they have the pricing power to pass their own increased costs onto the market. If raw copper or labor gets more expensive, Xylem simply raises the price of their industrial pumps.
And people just pay it.
Well, because water infrastructure is mission critical. I mean,
Yeah.
A city cannot simply decide to stop pumping water because the equipment got 10% more expensive. Xylem's customers just accept the price increase.
They don't have a choice.
Exactly. In the press release, CEO Matthew Pine states that their multi-year operating transformation is gaining traction. Out of that $1.12 of adjusted earnings per share, 6 cents of improvement came directly from these internal productivity and pricing efforts.
That is basically proof that a massive industrial company can actually grow its profits through rigorous internal efficiency, even when the broader market demand totally levels off. They aren't just waiting around for a booming economy to drive sales. They are looking inward and tightening the screws.
It demonstrates a highly mature management team, They are not using macroeconomic uncertainty as an excuse for poor bottom line performance.
That's a really good point. But Xylem isn't just one single monolith, right? That margin battle is being fought very differently across their various business units.
Very differently.
So to see exactly where this pricing power and demand is coming from, we need to dive beneath the surface and look at their individual segments. And when you look at the breakdown, you find some absolutely fascinating anomalies.
Some big surprises in there.
Yeah, let's start with the applied water segment. This division brought in $448 million in revenue. Overall revenue here was flat, which they say was dragged down by declines in industrial and residential markets.
Right.
But their future orders grew by 5%, and the sources specifically state this order growth was driven by demand from U.S. data centers.
Keep that data center detail in mind because it is incredibly vital to understanding modern infrastructure.
Oh, we will definitely circle back to that. But next, you look at Measurement and Control Solutions, the MCS segment. They did $508 million in revenue. And orders here didn't just grow, they surged a massive 18%.
18% is huge for an industrial company.
It is, and it was driven specifically by water metering. Meanwhile, the revenue growth in this segment was led by energy metering demand.
Yeah, lots of smart tech being sold.
Right. And finally, look at Water Solutions and Services, or WSS. They brought in $566 million. Q1 organic revenue here was actually down 2%, which the company attributes to capital timing.
It's Apple timing, right?
But right on the heels of that decline, the presentation highlights that they secured their largest order ever in April, a staggering $850 million mega order.
The contrast between these segments perfectly illustrates the duality of modern infrastructure right now.
How so?
Well, you have old-school infrastructure dealing with lumpy, delayed funding in one segment sitting right next to hyper-modern, explosive demand in another.
Okay, let's unpack the old school side first. What does capital timing actually mean for that Water Solutions segment? Like, why would revenue drop 2% if they are simultaneously landing an $850 million order?
Capital timing is just the reality of dealing with municipal governments and massive utilities. They move at the speed of bureaucracy.
Oh, government speed.
Exactly. A city council might recognize they desperately need a water treatment plant overhaul, and they might even approve the project in January. But the actual funds, the massive checks, might not clear the bureaucracy and get deployed until October.
So it's just a waiting game.
Right. So Xylem experiences a lull in Q1 revenue simply because the capital hasn't moved yet, not because the demand disappeared. Landing an $850 million mega order in April proves that the massive long-term demand for outsourced water management is absolutely still there.
Okay, so that perfectly explains the traditional infrastructure side. Let's look at the explosive growth side. An 18% surge in orders for the Measurement and Control Solutions segment is huge. What is driving utilities to buy so many smart meters right now?
The sources list AMI adoption acceleration as the primary market driver.
And AMI stands for?
Advanced metering infrastructure. There is a global rush right now by utilities to upgrade to smart infrastructure, and it all comes down to solving a huge problem called non-revenue water.
Non-revenue water, meaning water they can't charge for.
Exactly. Imagine a city spends millions of dollars treating water, adding chemicals, and pumping it out into the grid. But 20% of that perfectly treated water just leaks into the soil from cracked pipes under Main Street before it ever even reaches a residential meter.
Oh, wow, 20%.
Sometimes even more. The city loses the water, and they lose the revenue. In a world facing increasing water scarcity, that is completely unsustainable.
Yeah, that's just literally pouring money down the drain.
Exactly. And you cannot manage what you do not measure.
Yeah.
AMI, smart meters, detect pressure drops. They identify leak locations instantly, and they allow utilities to stop the bleeding. That is why smart meters are flying off the shelves.
Which perfectly explains the surge in the MCS segment. But what about the data centers? Why on earth is a water pump company seeing a 5% order bump from computer server farms in the applied water segment?
Because modern digital technology is incredibly water intensive.
Really?
Yes. When you use cloud computing or when you query an artificial intelligence model, physical servers in a massive data center somewhere are working overtime. And those server racks generate massive amounts of heat.
Right. Computers get hot.
Very hot. Traditional air conditioning just cannot keep up with hyperscale data centers or AI facilities. Cooling those servers requires highly sophisticated liquid cooling systems, industrial heat exchangers, and massive water pumps.
Oh, and those are the exact solutions Xylem sells in their applied water segment.
Precisely. The explosive growth in AI and data centers acts as a direct catalyst for industrial water technology demand.
That is wild to think about. Every time you ask an AI to write a poem or generate an image, a massive industrial pump somewhere probably has to push a little more water to keep the silicon chips from melting.
It bridges the gap between the digital world and physical resources perfectly.
Okay, so we have smart grid hardware flying off the shelves, data centers buying up heat exchangers, and an $850 million mega order landing in April. If they are wringing out internal efficiencies and landing these massive contracts, their bank accounts must be swelling.
Oh, they definitely are.
So what is a water company actually spending all that extra cash on?
The cash flow metrics in this quarter reveal a very aggressive capital deployment strategy. Let's just say they are not sitting still.
Let's run through those cash movements. Their year-to-date free cash flow surged by 147%. And just to give the ELI 5 version, free cash flow is basically the money a company has left over after paying its operating expenses and the capital expenditures needed to maintain its factories.
Right, it's basically the discretionary budget.
Exactly. So in Q1 2025, Xylem was sitting at a $38 million loss in free cash flow. In Q1 2026, they flipped that to a positive $18 million. And with this capital, they went straight on the offensive.
They really did.
During the quarter, they repurchased $581 million in their own stock. On top of that, they signed a $219 million agreement to acquire a company in the analytics space.
Yep.
And because of this healthy start, Xylem actually updated their full year 2026 guidance.
They raised the floor for the rest of the year.
They did. They are now expecting $9.2 to $9.3 billion in total revenue for the year, which is an increase from their prior guide. And they pushed their expected adjusted EBITDA margin up to between 22.9% and 23.3%.
Very confident moves.
But I have to play devil's advocate on how they are spending this money. They are spending over $500 million on stock buybacks, which, reduces the number of available shares and generally boosts the stock price to reward shareholders.
Right.
At the same time, they are dropping $219 million to buy an external analytics company. Are they just trying to buy their way into a digital transformation because they failed to build the software in-house?
That is a very common critique when legacy industrial companies buy software firms. But we have to look at how these pieces fit together. That $219 million analytics acquisition integrates perfectly with the massive 18% order growth we just discussed in their smart metering segment.
Oh, so they tie directly together.
Exactly. The core philosophy shift happening at Xylem is profound. They're no longer just selling physical pipes, valves, and pumps. They're selling the whole ecosystem.
Going back to the idea that you need to measure the water to manage it?
Exactly. A smart meter without software is just a piece of plastic and metal. Integrating advanced analytics allows them to offer a complete package to a municipality. You don't just buy a meter, you buy the software platform that uses algorithms to predict exactly when a pipe is going to burst, based on the data flowing from that meter. As for the buy versus build debate, buying an existing analytics firm gives them immediate speed to market in a highly competitive sector.
So they are basically buying the ecosystem rather than waiting years to develop it from scratch.
Precisely. And regarding the share repurchases, generating enough cash to return over $500 million to shareholders while still funding a $250 million acquisition that shows a very healthy balance sheet.
Yeah, they have cash to burn.
And furthermore, management raising their full-year guidance in the very first quarter is a really strong signal of confidence. They clearly believe this execution isn't a one-off fluke. It is a sustainable trend built on a massive foundation, specifically their $4.7 billion order backlog.
Wow, $4.7 billion. So that backlog acts as a crystal ball for them.
It really does.
They already have $4.7 billion worth of orders just sitting on the books waiting to be fulfilled. That gives them incredible visibility into their future revenue, which obviously gives them the confidence to deploy capital aggressively right now.
Exactly. It is a pure demonstration of structural resilience. They have the orders in hand, they have the operational discipline to expand margins despite inflation, and they have the cash to acquire the technology needed to stay ahead of the digital curve.
Which really brings it all together for you, the listener. This deep dive reveals that reading an earnings report is about so much more than just checking whether a company made or lost money.
It's a window into the whole economy.
Right. By looking at Xylem's Q1 2026 presentation, you get a highly detailed map of global priorities. It shows a company squeezing out real profit through sheer operational discipline on the factory floor, even in a flat market. It highlights how they are perfectly positioning themselves for massive macro trends, like utilities desperately trying to fix non-revenue water leaks with smart grids, and cities totally outsourcing their massive water treatment projects.
It fundamentally changes how you view a traditional industrial company, right?
Hmm.
They are operating right at the intersection of heavy physical infrastructure and advanced predictive software.
They really are. And as we wrap up, there is one final, somewhat provocative thought. We want to leave you with something for you to mull over the next time you turn on the tap or log on to your computer.
This is the big question.
Yeah. We saw in the source materials that water scarcity and climate are explicitly listed as key market drivers for Xylem's legacy business. Municipalities are fighting to conserve every single drop.
Because there's just less of it.
Right. But at the exact same time, we saw explosive growth in their applied water segment, driven directly by U.S. data centers.
And this raises what might be the most vital question for the next decade of technological advancement. As our digital world expands relentlessly, and as artificial intelligence requires increasingly massive, power-hungry infrastructure, will our ultimate technological bottleneck be our ability to manufacture the silicon chip?
Or will it be something else?
Right. Or will it simply be having enough physical water on the planet to cool the servers down?
Man, it is a wild thought. The next time you wince at your utility bill or check your basement for a flood, just remember, you are participating in the exact same physical circulatory system that keeps the artificial intelligence running and the internet online. Thanks for joining us on this deep dive.